So this is the outline for the trading strategy that I currently use. I recently created this strategy and have been back testing and forward testing it for a few months now. I have about 9 months worth of data and a handful of conclusions that I've reached from said data. I'm going to consolidate all of my findings and review this strategy in its current state. Vocalizing and organizing this information will also dedicate my findings to memory and allow me to further process how I should approach trading moving forward. Every trader has specific personality traits and habits they must work around when building a personal strategy. Some preferences I have learned through 3 years of trading include the following. So I like having no more than 2 hours a day on the computer. I've personally limited that to actually an hour and a half is my compromise. I'm never on the computer trading for longer than that. Sometimes I am on less than that though. Daily bias hurts my psychology. Whenever I have to sit there and decide for a particular strategy whether the market might go up or down in that day, therefore only looking for sells if it's going to go down or buys if it's going to go up. That kind of hurts my psychology because I have to decide something, and then if I'm wrong, it makes me mad. I only like to trade 1 to 2 instruments, prevents me from getting distracted from looking at one instrument, prevents me from missing out on setups. I actually only trade the NASDAQ on this strategy. I like the 5-minute. It's fast enough that things happen quickly, but not too fast to where I can't analyze what I'm actually looking at. I like trading fixed risk reward trades. For instance, every trade I take is either 1.5 to 1 or 2 to 1. I don't aim for targets that might be 1.8 or 1.3 or 2.3 to 1. I have a fixed money amount that I will lose or gain for the day, and that helps me so I don't get greedy trying to reach a certain target. My win percentage needs to be above 40 to 45%. There are plenty of strategies with 60, 70, 50, 55% win. As long as it's above 40 to 45, that's the amount of losses that mentally I can handle. So less trades in a day is always better. I found that my maximum is 3 before things start to get kind of weird. So I've limited myself to a maximum of 2 per day. I only trade mornings. This works with my schedule as I live in the US and have a job and whatever. So an hour and a half in the morning for New York session just works out perfectly. My strategy also has to be prop firm friendly. So most of these prop firms have on the lower end a 2% drawdown limit per day. So if I lose 2 trades in a day, I structure that around the daily drawdown and I will never hit that. Every day I trade the break of the 845 candle. If it breaks the high of the 840 candle, I buy. If it breaks the low of the 840 candle, I sell. I try to implement a generous stop loss to account for some volatility. I always aim for 1.5 R on this trade. If it wins, my day is over. If it loses, I immediately enter another position in the opposite direction that aims for about 2R. If the stop loss for the first trade is hit at or past 10 a.m. Central Time, the second trade is never entered. That's it. Very simple strategy. It allows me to be consistent. It's very sustainable for me, and I am able to execute it on a consistent basis. There are some details I have studied that could increase profits of my strategy if implemented correctly. These include scaling out, scaling in, trading while in drawdown, increasing my risk to reward ratio, holding through market close, messing with the stop loss size, and risk management based on setup quality. Here are the results I have found from analyzing these topics. There's a 54% win rate, 259 total trades in the time period, and it garnered 97 R. So whatever you're risking, that times 97 was the profit. And specifically the 845 trades, 49% win rate, 36 R. On the second trade, the retries is what I call them, 65% win rate, 61 R garnered. The first detail that I studied was holding through close. There were 19 trades that did not hit either the stop loss or the take profit and had to be closed right before market close. Those trades had a 73% win rate, garnered about 6.5 R. I found out that holding these through close will gain more profits. You can see holding through the weekend, though, does not gain more profits. So the stop loss size was next. This statistic is important and a bit hard to navigate This is the only decision that I actually have to make with this trading plan, and therefore the only opportunity for me to use my own discretion and possibly make a mistake. I don't use strict stop loss sizes or price action criteria. I choose the size based upon a combination of recent price action, volume, and vibes. I just kind of wing it, I'm not gonna lie. Here are some examples that I have found to kind of show you how I decide my stop loss size. So on this example, that big drop that had happened, I really just wanted to cover that one. I don't usually ever feel the need to cover all liquidity, so you can see there's a couple highs above it. I don't always feel the need to put my stop loss above that, but I do want to cover any imbalances, so any like what you would call a fair value gap. So as long as I'm covering those large candles for the most part, I feel comfortable with that. On the flip side, the other trade that I took, the second trade, as long as I, again, can cover that big push upwards and cover any of those gaps, I don't have to go all the way to the bottom, but as long as I cover most of it, I feel comfortable. On this example, I just wanted to cover, again, that big drop that had happened about an hour before I took this trade. It had been dropping much longer before that, so I didn't need to cover everything, but just the big drops is what I want to cover. And then on the flip side, the big push upwards that caused the first trade to lose, I just wanted to cover most of that. There was some kind of liquidity and that big wick that I also felt I wanted to get most of, but I didn't feel the need to get all of it. This one kind of took a while to hit a target, still won because my stop loss was big enough. So on this one, the way I'm viewing it is that giant wick below that I'm placing my stop loss in the middle of, that took a lot of liquidity from hours before, so I did not feel the need to put my stop loss under that wick. As you can see, it still took liquidity from that wick, but it was a good 18 points that it slipped past that wick. So even if I put my stop loss 15 points below that wick, I still would have been stopped out. I never put my stop losses more than 15-ish points below a high or a low. And then on the opposite end, I just wanted to cover a lot of what had been going on in the hour before, so I basically brought it up to the high of the day. So this trade was interesting. This was actually Labor Day. I do still trade holidays because they are still winnable, but the volume is going to be lower on these days. The first trade that I took, as you can see, was around 34 points or so. And it caused me to have to take the second trade, and then I lost both of them. But in reality, as I've decided that bigger stop losses are better, I tend to stray away from anything below 50. And if I had simply had my stop loss 55 or bigger, I would have only taken the one loss here, as you can see. So interesting outcome here. 38 trades could have had different results based on the size of the stop loss. I tested if bigger stop losses on every single trade over this period would have been better or smaller would have been better. As you can see, bigger is better, and holding past close specifically as well would have been better. The smaller ones, I didn't have to test holding past close because with the smaller stop losses, they would have hit either the stop loss or the take profit before the market closes. So next, I studied the quality of each trade. Buying low and selling high are concepts that you kind of want to implement into whatever strategy that you use. My strategy doesn't depend on any price action, however, so some of these trades will kind of be buying high or selling low. So the only way that I'm going to be able to show these examples is through records that I've recorded on the site Airtable. So June 12th is an example here. So I think this is kind of an obvious buying high example. You can see this giant push up here, and it barely even retraced at all. All of this empty gap has not been filled, even some of the gap down here to where that push started. And then I didn't even get into the trade until right here. So that was after it pushed and broke this high. It kept pushing upwards. So this is extreme high buying. But as you can see, the trade still won. So here's another example, March 12th. As you can see at 8:45, this is the candle down here that I had to enter off of and selling at the low of the day. This is
selling low, this is a great example of selling low. You can't really get any lower than this. March 5th here is another example. So as you can see, we're going down for hours. It kind of retraced right here, but it started pushed down here, and then we broke the low of the day on that big candle right here, and I got in way down here. Now again, this is just a trending day. It still wins, but it's definitely kind of scary to enter a trade like this. So this is a not as obvious example. So you can see down here, like we were pushing up for a while, another break of the high, swing high here, and then a retracement down here, and then where I got in wasn't too bad. So in relation to everything that happened over here, this isn't really buying high, but it's kind of in relation to what happened earlier in the day. This looks like around midnight or London session, 2 a.m. or something. So in relation to that, it's a bit of buying high, but nothing too crazy. And this is another example, which isn't exactly super obvious, I suppose. So this one, I'm talking about the sell here. You can see that we had been pushing down for hours. It did make a large retracement here, and so this is kind of like I'm taking the sell at the breakout. But since there was a retracement, it's not the worst. But it's still scary. We've been dropping for hours. It's carrying on with the trend, but usually you want to get in around here, closer to the beginning of the retracement. But it is what it is. The strategy still won. I had to have a larger stop loss because I wanted to cover this whole retracement, and it turned in my favor.
So 62 out of all 259 trades where we're buying high or selling low. First, we're going to look at the 197 that did not fall in these categories. 134 trades of the 845 variation, 51% win rate, 32R, and then the other 63 had a 67% win rate and 54R garnered. Since these trades did not fall into the category of buying high or selling low, these would be considered higher quality than their counterpart below. So if I risked a bit more, you can see I would have gained an extra 6.4R on the 845 trades and an extra 10.8R on the retries. The other 62 trades that did fall into those categories had a 47% win rate, 13R. You can see the breakdown below. It can be concluded from this evidence that risking less when you are buying high or selling low and risking more when you are not buying high and selling low is beneficial. You can see the 14.6 extra reward that you would get from doing so. So winning trades can experience drawdown. Is there a way to capitalize on this? The idea is that small trades, while in drawdown, if the trade happens to win, could boost profits. Any trades taken in drawdown would have the same target as the original trade, and risk amounts would vary. I would not risk the same amount on one of these small trades as the entire trade. So the idea is I chose a few different levels, the 50%, 70, and 80% levels where I would enter a new trade. You can kind of see here where those numbers would come into play. Halfway through the drawdown, you would get a 4 risk to reward trade. If you go down to the 70% level, this would get you about a 7R trade. And then all the way down, very close to the stop loss at about the 80% mark, gets you around 11R if that were to win. None of these options actually are worth it. They all will lose you money. And the further you go and trade and drawdown, the more money you will lose. So definitely not worth it. So you probably heard of the phrase adding to your winners can help. And I wanted to test this with my strategy. Can adding positions while in profit increase winnings? So there are 2 scenarios I wanted to test. I will show you examples. One is adding a position when 50% in profit. One is adding a position when in 30% in profit. The result was interesting as drawdown was pretty significant. The 2-to-1 risk reward trade method here was the winner, clearly, but it had as much as 8R drawdown. I understand that you would not risk the same amount that you would on the original trades, so this might not be a problem if you just risk a little bit, but it's not ideal for prop firm trading where you have a trailing drawdown. So some winners finish stronger than others. I wanted to see if I could capitalize on this idea. There were 138 wins. I categorized 37 of them as strong wins. That closed before 10 a.m. when I leave the computer. I categorize a strong winner by at least one of the last two candles before it hits the target to cover 30% or more of the range towards the TP. I tested a couple different scenarios here of closing. So the candle that hits the target, I tested closing the trade once that candle closes. I tested closing the trade when the next candle closes that closes towards the stop loss. So here you can see it's blasting towards my take profit, and instead of closing at the take profit level that I set originally, I wait until the next bullish candle because I'm taking a sell. I wait until the next bullish candle closes, and I close the trade once that candle closes bullish. And then the third scenario is closing the trade 2 candles after the take profit is hit. So in contrast to the first method, where the candle that hits the target, I wait for that one to close, I would just wait for the one after that to close. I also did the same for every win, whether it was a strong win or not, and I found that it can be beneficial to do this for all winners and not just strong winners. I only accounted for winners that actually hit the take profit while I was on the computer, so that's before 10 a.m. though. So with all of this data, a more ideal way of trading the same exact strategy can be implemented. It seems as though holding all trades through close is the move. Bigger stop losses are better. Risking less for the lower quality setups and a little bit more for the higher quality setups gets more profits. Closing strong winners after the TP candle closes is the best way to go. Not only is it going to be the easiest, I just have to wait a couple extra minutes for that candle to close. Applying this rule to all winners would just be a little too unrealistic. It's better to only have to do it to the strong winners. Do not trade in drawdown has been a conclusion, so adding to my winners will benefit me. Implementing all of these practices, including some human error, would gain 39, almost 40 extra R over the 9 or 10 months that it's been for me back testing this. If you actually add up all these numbers, they add up to about 49. So I took a good 20% away for human error. I think that's a pretty solid chunk and a very realistic outcome. Now, how realistic is implementing all of these ideas? What is required to apply all of this knowledge? Well, you're going to have to trade with a firm or a broker who allows you to hold through close if you want to take advantage of that. Most futures firms do not allow you to hold trades past market close, so pretty unfortunate. But if you trade CFDs, if you're not in the US, or even if you are and you trade CFDs or some kind of other way, options maybe, you can hold through close, and this is possible. If you're with a prop firm, especially futures prop firm, you can't have a trailing stop loss. You can make this work with a trailing stop loss, but you'd have to risk less, which in the long run, if you can sustainably execute this strategy, I think it's worth risking less because you'll make more profits even though you're risking less. You have to focus between 8:40 and 8:50 a.m. Central Time. When that market opens, things happen quickly, and when you're going to place that trade at 8:45, you have to be ready for anything that can happen. Sometimes there's news at 8:45 and the candle moves very quickly. You've kind of got to have buy stops and sell stops already placed at 8:44. If you're trading multiple accounts and you can't copy trade between the two like me, then you're going to have to separately enter trades on both platforms successfully before the time. And depending on where you trade, you're going to have a risk calculator or a chart available for you to look at. I do have a CFD account, and I don't have time to pull out my calculator and do number crunch based on how big my stop loss is. That 840 candle can be moving up or down as you are calculating your stop loss size and how much you should be risking. So you could be changing this number up until the 845 candle pops up. I've had to change my risk amount after the 845 candle has appeared already because the 840 candle is just moving that quickly. So I've created a chart. This is my CFD chart with the numbers on the left-hand side of each column represent the size of the stop loss, and then the numbers on the right represent the lots that I would have to input to achieve $1,000 risk because it's $100,000 account. I like risking 1%. And then if you're trading futures, I have a chart here. Futures are even more complicated. Since I only trade the NASDAQ, they do have the NQ and the MNQ. So if you want to risk different amounts of money, you can. Lots of these futures prop firms have limits on how many contracts you can place. So instead of placing 14 micro contracts on the MNQ, I'm only allowed 10, 12 contracts maybe. So I have to go between the NQ and the MNQ chart. So I literally have to bounce between two different charts on the same screen and place buy or sell stops in the correct manner and the correct amount. It's pretty fucking annoying, honestly, I'm not gonna lie, and I don't really hear anyone talking about this and why this just makes things complicated. I guess people just trade ES or something if they don't want to worry about this, but I don't know. That's just not how I operate, and the strategy does not work on ES like it works on NQ. So this is just an obstacle that I've had to overcome, and it's a pretty simple fix, but it's still annoying to have to look at this and in 30 seconds be able to type this into your computer and execute the trade perfectly. So I have the performance of my strategy on paper at least, labeled by month. December and January were short because I don't ever trade the last 2 months of December or the first 2 weeks of January because of holiday season. These results are based on the data I've collected, so they are not my results. Since the strategy is very simple, I am able to replicate these results fairly easily. It just depends if my stop loss is not big enough on one setup or two per month, which definitely does happen. For instance, August, I did not make that 4.7 R. I made closer to like 2 or 1 because I screwed up on a stop loss or two. Human error is going to be a part of the process, and I have to accept that. I've actually been funded 3 times with Top Step on Tradovate with this strategy. It's very easy to execute on Tradovate, I'm not gonna lie. I've never gotten a payout, however, because the scaling rule that they implement after you actually get funded kind of fucks everything up. They require you to only use up to 3 contracts once you get funded, and you have to work up your profit in order to use more contracts. That kind of prevents me from risking the same amount on every setup, and that's kind of the purpose of this, and what keeps my mental in check is the risk management of being able to risk the same on every trade. Right now I'm using Elite Trader Funding. Doesn't have a scaling rule and supposedly does not have a trailing drawdown because you can choose an account which does not have the trailing drawdown. This is a bit weird though because the last account that I had with Elite Trader Funding actually did have a trailing drawdown, so I'm very confused as to if I misread the rules, chose the wrong account, or if I'm being lied to. Supposedly the trailing drawdown is supposed to stop once you hit $100 plus the balance. So if I have a $100,000 account, $100,000 and $100 is when the drawdown should stop going up. I hit the trailing drawdown at the 101,000 mark. I am currently trading with them again. I have lowered my risk since, so hopefully that prevents me from hitting trailing drawdown in general, but no promises there. Elite Trader Funding does have static drawdown account options, but you only have a $625 maximum drawdown with those accounts, and that is nothing. I would have to change the way that I trade in order to not risk $600 on most of the trades that I take. My funded futures is another great option, but they're just a bit more expensive. If you want those accounts that do not have a scaling rule and do not have the trailing drawdown up to the balance, you're gonna have to pay closer to $400 or $500, which these other companies like Top Step and Elite Trader Funding are a third of that price, if even. And I don't really want to use Apex because I've heard they don't pay out everyone, and that just kind of scares me. So I'm just going to keep trading this strategy. I'm going to try and implement some of the new findings that this data has brought me, but it's going to have to be a one at a time kind of thing. I have one account that I'm trading not using any of the extra criteria that I've found, and I have another account, a CFD account, that I will be using some of these new concepts with. I've chosen to make this video because I believe I'm in a good spot with my strategy as far as knowing that it can work, but also knowing that there could be some improvements that I could implement. I've used it enough to where I feel confident that I can consistently execute it. The recent performance in August and September definitely does discourage me a bit. I know that every strategy doesn't win 100% of the time, so I'm definitely just trying to tell myself that, and I'm going to ride it out for another couple months. But we're going to see if I can take advantage of this strategy through any prop firms.